Hi everyone, can you guys hear me? Please respond in the chat. And let's see. Okay, people are joining now. Okay, yes, perfect. We have people here. Okay. So I'm doing this on YouTube Live. I'm going to share a link right now for questions because I know we'll get a couple of questions. Let me look for that link right now. And then as we go with this, I hope it runs well and there's no hiccups. That's just a prayer. Let me get them. Okay, perfect. Good morning. Pin this message. So if you guys will have questions, you can use that link to ask the questions as we go across. Just going to wait for a couple of minutes. Can you guys hear me now? Yeah, okay, perfect. Yeah. Okay. Let me know where you guys are joining from. Perfect. Okay. So where you guys joining from? Toronto, Calgary, wherever? Just let me know in the comments. And I have pinned a Mentimeter to the chat. So if you have questions while I go through this, you can ask me. I want to avoid looking at the chat for questions. So please use the Mentimeter. Okay, perfect. We have London, Toronto, Waterloo. I love it. Winnipeg, Ottawa. Yes. I love that so many people want to get into investing. And I'm just happy to see people investing. Okay, y'all cannot hear me again. Can you hear me? Uh, can you hear me? Yes. Okay. People can still hear me. Thankfully. Yeah. So Alberta, Vancouver. Okay. Nice. I'm just waiting for a couple minutes to get going. Okay. Let me share my screen so we can have it open. So most people can hear me. So I don't know, maybe it's your sound, but most people can hear me right now. So please check it out. Okay, perfect. Okay, let's get to it. So a couple of, as I said, housekeeping tools. Please let's um stick to the Mentimeter. Please don't ask questions in the chat because that would distract me. And let's get going. So investing workshop. Now, a little about me. If you don't know me, you might have just come across um my videos on just talking about investing. I'm not Canadian, Nigeria. Yay, became a Canadian recently. And I moved to Canada a couple of years ago, about 5 years ago, as a student. But something that's been really interesting to me also has always been personal finance. I've always been investing, always been in that game. And I also like to travel, solo travel. My first solo trip was to Colombia and Panama, and having Nigerian parents, knew that was very stressful for them. I like to talk about money, as you guys know, and I love tennis. I feel like in another life, I feel like I'll have become a tennis player for sure. So now, what this is going to entail, or the agenda for today, is what is your why, investing basics, how to choose the right account, how to pick your first ETF, a simple investing strategy for 2026, and just like how to grow your wealth over time. Um, so let's get into it. So, what is your why? So, I wanted to avoid talking about the textbook, oh, to grow wealth, to build wealth, to have money, because at the core of it, like this is why a lot of people want to get into investing. You're feeling like, oh, you're tired of feeling behind. You just feel like, oh, everybody's going forward, invest or doing things like they're achieving big goals. And it's just like, why am I not doing things like this? Or now you want to see how like people have built their wealth. You're saying, okay, they built a 100K net or they built a 400K net, or how did they achieve that? Also, you don't want to struggle in the future. As someone that like is black, I get to talk to a lot of people about like black tax. And I know that that's something that we don't want to see going forward into our own generation. Yes, maybe our parents or our family members, we have to do with that, but like it's like you don't want that to be your own story in the future. Another thing is that life has gotten super expensive. Like the reality is that life today versus 5 years ago versus 10 years ago was not as expensive. And so you're also thinking, what would the future be like if today is this expensive? What's the future going to be like? Like I need to start thinking about long term, and all those type of things. Another thing is that you want to break generational cycles. Like you want to build $1 million investment, or you want to be able to just give back to your community. You want to be able to do things that you wish your family was able to do. Another thing is that you believe it's possible to build wealth. Now, I say this because like even for me, like I coming from Nigeria, like in my head, like I was just like, oh yeah, I would have money, but in my head I didn't think of how possible it was. Like it felt like it was only the rich that were able to do it, those people that were already at the top that could stay on the top. But like having learned more about investing, like it's a game changer, and it's not for just the rich, it's literally for everyone. As long as you're able to like know the right principles, get in, you should be able to invest and build wealth. Another thing is options and freedom. Like, who does not love options? Like, I find that talking to a lot of people, at the core of it, when they're like, oh, yes, I want to be able to do this, it's like they just want to have options to do what they want to do. They want to be like, okay, can I just like take a break from work? Or I'm just like overwhelmed and burnt out. And they want to be able to have to think, do these things without having to think about money. Another thing is that you don't want to miss another year not investing. And that's something I have been saying to a lot of people. Most people say, oh, I'll get started next year, or I'll start this week, I'll start next month, but they never get to it. And the goal is that you want to actually go into 2026 actually investing. So let me know in the chat, or I know I said no questions, but let me know in the chat what's your why, some of your whys, and kind of like why that is motivating you to kind of come on this call here. And then next thing I'm going to do now is to talk about kind of my journey, what I've been able to do, just so you see what's possible. And I like to talk about this because I feel like, and that's why I like the whole concept of personal finance connect creation, because it shows like everyday people what is possible, like what other everyday people are doing that is not like they have crazy amount of advantage, but they're able to just start something and build something. So I moved to Canada in quarter four 2019. So I came to school right before COVID. It was a tough time. I did not enjoy being a student. But I did that. And what helped me, and I also came with student loans. So um, the goal was for me to go to school and to be able to then pay off that student loan. And between like 2021 and 2022, when I graduated, I paid off my 21K student loans. And was off of really budgeting and saving. Because I had to be really strict with my budget. Like I had to really sit down and feel like, okay, this is what I need to spend, and really focus on paying off that debt ASAP, because it was high interest debt. And then within 2 years, I literally hit 100K invested. Like, and I have to say, when I had 21K student loans, like I was on a 60K salary. And so the fact that I was able to pay that off in that short time was like, even me, I was surprised. I'm like, girl, how even now today means like, how did I do that? And then within 2 years, I hit 100K investing. And what made a difference for me there was now focusing on saving and investing. A lot of the money was not money I put into the market. It was actually money that was like my interest and my gains from investing. And then another thing milestone that I have not yet shared, probably like probably first place I'm going to be sharing this is that beginning of this year I actually bought a house, all on my own. And all of these things, me being able to buy a house was through the whole concept of budgeting, saving, and investing. Investing being the major driver to increasing my money and my net worth. And then what is outstanding is that this year, because I bought a house, like a lot of my finances has been all over the place. I've been saving all this, like I've been trying to build back my emergency fund. I've been like trying my best. So I would say that I have not invested as I would have in previous years. Like I have not been as aggressive as I would have in previous years. But then guess what? Like even with that, like after having taken out a lot of money to put down the down payment, I actually am still going to hit 100K invested by the end of this year. And that's even crazy because even me looking at the normal math, it didn't make sense to me because I was thinking, okay, next year we'll try and hit the goal next year, we'll be aggressive. But like the fact that the market still rallied, and that's including the fact that the market has gone up and down so many times this year, like in the last couple of weeks, we're still down. But then I still like be able to hit this amount. So that's what this is just showing you guys what's possible. Like not trying to say, oh, okay, I don't anything out of the blue, but just showing you guys what is possible, being consistent. And I also have to mention that even with me investing like this year, as I said, I've not been as consistent or as aggressive. I literally just set an automatic investment of $100 every single month. So every single paycheck. So that's like $200, literally. So you see what's really, really possible. Thank you guys. Thank you guys for the congratulations. Thank you. So now let's get to it. However, before you get into investing, something I had to mention is that like investing is not like the immediate step, like bam, okay, I'm trying to become financially free. Let me go and jump into investing. There's a whole lot of things that come before investing. I need to have the structures in place to invest. Have an income. Like at the end of the day, you cannot invest money if you don't have a certain level of income. Now, the income does not have to be crazy high. Just have like an income, a source of income. That's important. Another important thing is having an emergency fund. I find people where they're like, oh yeah, I want to start investing. I'm just like, okay, first of all, do you have an emergency fund? Like, do you have something, a rainy day fund for like just because life happens, there's a lot of emergencies that happen. So that's another thing I'm going to mention. If you guys do not have an emergency fund, I would definitely recommend you prioritize building that emergency fund. And what is an emergency fund? If you're just new to that, it's 6 to 12 months of your living expenses that you keep in a high interest savings account for emergencies. So for instance, for a loss of a job or health scare or things like that. And then from there you can then start to build out like your medium term goals, like you want to save for a house, for instance, or you want to save for a car, those type of things. But I want to emphasize the income piece and the emergency fund piece. That's important. Now let's talk about investing myths. Investing myths is that it requires a lot of money. As I said, that was something that I even struggled with in the beginning because I thought that I needed to have a lot of money for me to invest. Like, thank you guys. I needed to have a lot of money for me to invest. And I required perfect timing, like I needed to time the market or things like that. Or that you need an expert. Like there's a lot of financial advisors, and I'm not saying that they're not doing their job well, but I just feel like there's a lot of fluff and there's a lot of barrier to what investing is. And it's really way simpler than that. I feel like maybe also because we're in a capitalist society, everybody's like trying to keep investing and just like things like that. But there's so much, is way easier than you think it is. And so it does not require a complex strategy also. And so here are some of the investing truths that I'll say. A simple plan. You literally need a simple plan to start investing. You don't need to have 100 stocks. Now, some people have 100 stocks, 100 ETF. If that works for them, that's fine. But most people don't require that realistically. Consistency over everything. Routines. As I said, I'm just investing like $100 bi-weekly every single month, just to keep investing. Some months I put more money if depending on like how much I have. Um, Having clear financial goals, like have a goal. And that's something I find that people struggle with. Like everybody is trying to take on other people's goals. Like when I speak to people, it's like, okay, what is your goal? What is your dream life? Like, what do you want to do? Not everybody wants to buy a house. No, not everybody wants to travel. Like, you have to find what works for you and then structure out your investment plan and your financial goals based on that plan. The next thing is having the right accounts and tools. The right account and tools will make or mar like your investments. Like, especially if you're doing mutual funds. I have hate against mutual funds, but yes, having the right plan is so important. So now, fundamentals of investing. So now, after we talked about like just like the mindset piece, the why piece, here are some of the fundamentals of investing. Before I walk you through how to actually put this into practice and get to it. So the textbook stuff. What is investing? It is putting your money to work so it grows over time. That's really as simple as it is. You are putting your money to work versus keeping it in a savings account that would just stay there. Now, on average, because of Bank of Canada rates, now the highest you're probably getting is 3%. And inflation is higher, yeah, it's higher than 3%. So it's like if you keep all of your money in your savings accounts in the next 5 years, the buying power of that money is not going to be the same as today. And so you don't want to keep a lot of money in savings. Keep your emergency fund, your short-term goals funds there. But outside of that, every other thing, please do invest. Now, another thing to talk about is types of investments. So stocks, bonds, real estate, ETFs, treasury bills. There's also business. There's so many things you can invest in. So stocks, as you guys know, is when you have a share of a company. Um, and so I would say, for instance, like Apple, most people have an Apple iPhone that they use. Now you can decide, oh my God, I like this product a lot and I use it every day. I see the value. Maybe I should buy a share of the company, and then you go on the stock market and buy a share of Apple as a company. So that's what stocks are. Bonds, on the other hand, is borrowing money. So you're getting interest or income from giving somebody money. Like for instance, the government, mostly the governments that you would do this with, or even like companies have bonds. You borrow them money, they give you back interest. It's very, very low risk, low returns on that. Real estate, there's different ways. Real estate is a dicey one because I always like to say that it's not all real estate that is investments. If you're living in the house, it's most likely not an investment unless you're smart with it or you're strategic with it. But like when you buy an investment property where you're earning, for instance, cash flow, rental income, and you are building equity, that will be considered an investment. Now, another one is ETFs and index funds, my favorite. Not all index funds are created equal, but ETFs is a basket of stocks. Now you can see here, like that's why I put a basket of fruits. Like, you know how I talked about Apple? Now, if I wanted to buy an ETF, rather than me saying, okay, I use Apple, I can say, okay, let me buy an ETF that I use that includes technology I use. I can say, okay, Apple. Maybe for instance, I have a Tesla car. I can put Tesla in there. Maybe for instance, I have a Microsoft um 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 what's Microsoft email or something. You put Microsoft there. You Google every single day. Like, okay, I'm going to put Google in there. That's how we come about ETFs. And I feel like ETFs are so underrated. Like even for me, like all of my investments I've been in this year has been mostly ETFs. Because I just don't have the capacity to be thinking about researching individual stocks. So ETFs are such a good place to start with and even to stay invested in. I like to say I recommend people do an 80-20% split. Even if you decide, okay, I'm still interested in individual stocks, let your foundation of your portfolio always be ETFs because you cannot time the market and the indexes will always do work. So whatever you do that tracks that index is better. So treasury bills is also kind of a handshake thing with like the government where you borrow them money and you get some interest on it. Now, investment principles to know. So when it comes to investing, there's just some things that you have to know about the whole concept of investing. So there's a risk and return trade-off. Now, the higher your risk, the higher your possible returns, the lower your risk, the lower your returns. That principle holds every single time. So looking at this chart, we're seeing bonds return is like 2% or something versus blue chip stocks, like the higher you go versus growth stocks versus speculative assets. I don't recommend speculative assets. This is just for showing you guys. But yes, the higher your risk, the higher your return, but also the higher the losses if anything happens. And that's why I like to really, really emphasize ETFs and ensuring that your portfolio is diversified. Another thing I have to talk about is like when it comes to risk, it's also important that you know your risk level because like investing involves risk. However, the thing is that some people don't know how to like identify what their risk level is, and sometimes they get burnt. Like for me, I'll say I'm definitely medium to high term risk, and that's also because I have the advantage of time. And so having a medium high risk is good, especially when you have time on your hands, versus someone where it's like they're already closing on retirement. They can't be too risky because they need to protect the assets. So and even if you're now young, so on the other hand, if you're young and you're just like, yes, my risk is too low, I think how I want to think about is long term. The trade-off between like long term, you have a longer time for you to really go through the markets, and I'll really show you guys how like the market moves, all those type of things in this call. But then that long-term pace makes a whole lot of difference. And that's why we're talking about time horizon. It matters a lot when it comes to investing. The longer time you are invested in the markets, the better for you every single time. And so that's why I also recommend to like start early. Like you don't need to know everything at once because you don't need to become an expert at it. Yes, have the beginner knowledge of it, what you need to do, what it entails, but you don't need to know every single thing for you to take that next step to investing. Now, other investment principles to look at is compounding interest or compound. I feel like this is it's always hard to explain what compound interest means, but I'll use this analogy for you guys. So imagine like you plant a tree, like you have a seed and you plant a seed. That seed grows to become a tree. Then that tree has seeds again that drop. Those seeds again become trees. And so you can see the multiple effects of what's happening there. That's kind of how I want you to picture how compounding works because even with explaining in layman English, sometimes people don't still get it. Even for me, it's just like I can just show you what it is. Explaining it sometimes a little bit hard, but that's really the power of compounding, and that makes a whole lot of difference. The catalyst when it comes to investing. Now, another thing I want to talk about is diversification. Diversification is such a big thing, especially for an investor. Like if someone should say they want to just buy one stock all in on Apple, for instance, that is so risky because anything can happen to Apple. Yes, we love it. We think it's a good company, but the economy can mess it up. There can be trade wars or things like that that will mess it up. So it's a huge risk to stay invested in one stock. And that's what this graph is looking at. So if I pull, for instance, year one, $500 in one stock, by year two, it goes down to 350. I've lost some money, and that's the only stock I purchased. Versus if I have like 4 different ETFs or whatnot in my portfolio, even if that stock went down, my other stock may go up and everything will balance out and I'm still up. And so that's the concept of diversification, ensuring that you're spreading your risk across the board. It can be across assets, across geographies, across whatever it is, across industries, but ensuring that you're properly diversified. Nice. Okay. Now, this is another thing to just talk about the concept of compounding. I know I shared this on social media a couple of days ago, and the fact that if you start investing at 820 and you're just doing $690 every single month and contribute just a total of about $330, your total earnings will be 2 million at age 65. Now you can be like at age 60, you can be like, please, I don't want to retire at 60. You may need to put in more money to make it faster. But you can see my points there. Like putting $690 every single month for most people at some like middle age 25 is not that hard for them to do. And so if you are just consistent with that, you will literally become a millionaire just by staying in the market and like just letting the market do its work. Versus someone that's like 30, 40, or 50, they have to put in more money. And so that's like the value of timing, of having a long time and compounding our work here. Now, how do you make money from investing in the stock market? Also, just a reminder, if you guys have questions, please use the Menti meter question thing because there'll be a lot of time for questions at the end. So how do you make money from investing in the stock market? Specifically, majorly through capital gains and dividends. So capital gains is, for instance, I buy a company, Apple, at $50. Now, tomorrow, because maybe they have sold more Apple phones, they are becoming more profitable, the cost of that Apple stock goes to $60. That $10 dollar difference is my capital gain on that investment. And that's what happens a lot with growth stocks and why people like to do growth stocks, because you can buy a company that you're like, okay, this is currently undervalued, but I really think that this company is going to go to become a really great company. Then you buy into that stock at a okay price, and then it grows over time. So that's capital gains. The other hand is dividends. So dividends is profit sharing. So when a company like um Apple will be my sole example, they make profits. They're not like, okay, all our shareholders, let's give them some piece of this pie. So you're going to also get dividends from them. I don't think Apple is a dividend company, sha, but that's literally the concept of investing and how you make money. Because people are always confused. Okay, you say if I buy this, I want to go to this. How does that even work? This is the true reason why it works: capital gains and dividends. And some of the things that influences capital gains specifically is just like the market sentiment, and also like how like their management is, and also because maybe even just like people like the product more. In recent times, we've seen Nvidia grow up because of the um, AI boom thing that's coming up, because everybody's really, really bullish on AI, and that's really why the value keeps going. Thankfully, they also have earnings to show for, but really, that's how capital gains comes from. Yeah. Okay. So now, how should I invest in 2026? That's the big question. How should you invest in 2026? I don't want you guys to go into 2026 not investing. Like genuinely, like let us like get into invest, even if it's low efforts, something. But let's just start investing. My big answer is normally ETFs, and I think, and I say this because for most people, as I said, very few people will do well investing in individual stocks, because individual stocks require a lot of time to really understand what is going on behind the curtains. Now, there's some cases where it's like you just know a good company and you buy, irrespective of doing the math. For instance, Google, for instance, is a good company. No matter how long that you've had Google, it will most likely do well because it is such an integral part of everybody's lives. So companies like that, I guess why you may want to invest in that. But if you're thinking new companies, whatnot, it's harder for you to really like come out on top with individual stocks. However, you can still do it. And even for me, before I sold like most of my stocks to buy the house, I had a lot of individual stocks, and most of them with VFV also gave me like a lot of my returns. But now I'm heavily focused more on ETFs because that's just where it is at. So exchange traded funds, as I said, this is a basket of stocks that helps you to diversify your entire portfolio and limit your risk. Now, this is how I would kind of go through the process of investing. Know your goal. Know your goal. Like if you're in the comments, like what are some of your goals right now? Like, do you just want to build wealth? What are some of your goals? Let me know in the comments, in the chat. I keep forgetting what some of your investing goals are right now. Do you want to just like build wealth, or you just be like, oh yes, I just want to invest, get into the market, or you want to invest because in the future you want to buy a house, or you want to invest because in the future you want to buy a car? What will be some of those goals? Long-term investments, build wealth, yes, 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 yes. Build, I like that. Build sustainable wealth, something that you would actually sustain for a very long time. Build wealth. Yes, most all of us are literally saying the same thing. Build wealth. We're just trying to become free and have options. So know your goal: short to medium term investor, long term investor. I believe most people should be long term investors because that's when you really see the benefits of the market. You can also still try to do short term investing, maybe for specific goals, 5 years um down the line, but most people should be long-term investors. Next thing is to identify your risk level. Are you conservative to moderate? Are you aggressive? Um, I get the, and even as a finance content creator, I like the whole like, oh, invest now. But it's also important that you also understand where you are at. Like, are you somebody that if you go and invest, you'll be having anxiety, you not be able to sleep? You don't, if you're that type of person, there's a type, like there are different types of ETS you rather buy versus buying the one that will give you anxiety. So identify your risk level: conservative to moderate. Are you aggressive? You love to dabble into what is the popping thing in town. After doing your research, for sure, identify your risk level, because that will help you build a balanced portfolio. Now, for instance, if you know that you're conservative to moderate, you probably hold a mixture of fixed income, bonds, and equity. You won't just have equity alone, because equity is the higher risk. So equity is actual stocks that type of thing versus bond, which is lower risk. And aggressive, you can stick to just high equity and keep it moving. Now, choose the right account. So tax advantage accounts are the first step to start. Like, you want to get the best tax advantage as much as possible. Another thing is choosing um easy to use platforms. Like, there's so many confusing platforms, and that's some of the cons of like the entire finance space. It just feels like they've tried to make it harder and harder for people to get into the market. So some of the platforms are really confusing. So look for an easy platform to use to invest, and also look for something that has automation, something that you don't need to be constantly going to the account to do yourself. It will automate your investment for you. Then you have to find and research ETFs. So MERs, which is management fees, the management, the governance, the diversity of like the portfolio, where it is, all of those things. We'll talk about it next. So now, another thing I wanted to talk about is just like the volatility of the markets, because I'm not going to come here and tell you like investing is a get rich scam, number one, and investing is not. There are sometimes the market is down, sometimes it is red, but then as I said, shifting your mind frame to long-term investing makes a difference. It makes a difference a whole lot. And I'm saying this because even a couple of days ago, I checked my portfolio and I think I was like down a couple thousand. And now this morning, when I checked again, it's back up again. So it's like it moves every single time. So looking at the S&P 500, which is one of like the biggest indexes, and we have a lot of history of data here, you can see how 5 years ago, like literally just 5 years ago, it was in the mid like 3,000 and something for like the S&P, like the amount for the S&P 500. But you can see also like there's so many movements, so many dips, so many like everything, a lot of things was happening. Even in 2022, there was a lot happening with was this COVID? No, this was before COVID. But there was a whole lot of things happening with the economy and whatnot. Even in 2025, there was a big, like the beginning of this year, April, when the market came down, it was a whole lot. See how far it went down. But then over time, even irrespective of the dips and cracks and everything that is happening in the market, it has still gone up. So if I just bought VFV in 2021 or 2020, and I just said, okay, it's only VFV I'm buying, no, I will still have me up about 88% if I just kept it at that. So you see how like the market works. It would fluctuate a lot, but then long term it's still on the high side. Now let's get into where to invest in Canada. Passive income. Okay, yes. So answer what S&P 500 means. So S&P 500 means is Standard & Poor's top 500 companies in the US. I'm sorry for not explaining that. And so it's an index that tracks the top 500 companies in the US every single time. And also another reason why I like that is because that means it's a self-cleansing index. So that means per time, every single time they do the review, it will always be the top 500 companies in the world. And so that's why, irrespective of you investing your money there, you shouldn't be scared that, oh my God, if this company should drop. If the company drops out of the top 500, it's out of the index. Because every single time they're reviewing it and keeping the top 500 companies. And so that's another thing to keep in mind, where it's like, that means I'll always have the top most innovative companies in the world invested in. Like, that's a plus for me. And I don't have to do the work of researching. They just do that through the S&P. That's important. Yeah, somebody said that's almost 100%, literally just 100% of just staying in the market in the last 5 years. That's it. Then let's get into where to invest in Canada. Investment vehicles. As I said, tax advantage accounts, TFSA, RSP, FHSA, RESP. Obviously, because of time, I wouldn't be able to like go into more details of this, but I have a lot of resources on my platform about them. I even wrote about it in my blog. But the TFSA is a tax-free savings account. As it says, that means all of your gains, all your capital gains, your dividends in that account, when you withdraw it, it is tax-free. So, for instance, I put 10,000 in, and then 10,000 because of the markets working and everything. I added 10,000 in. 20,000, if I take out that money, for instance, I'm not going to pay any taxes for it. And that's literally what I did. So my TFSA was the primary account I used to buy my house. And I took a lot of the chunk of it out of that TFSA, and I did not pay no taxes for it. Another good thing about the TFSA is now I'm able to contribute the exact amount I took out, even if my contribution room, based on the normal calculations, is not up to that amount. But because that account grew to a certain amount, I can return back that exact amount into the account. So I definitely recommend the TFSA every single time. One of the most flexible accounts definitely to use. Now, RSP, retirement savings account. I know some people do not like the retirement account. I don't know why. I At the end of the day, all of these accounts have the benefits and the you just need to know how to use it properly for you to manage your investment. So the RSP account is a good account, especially for retirement. You just need to manage it properly and have a plan for how you're going to take money out of it in the future. That's the only thing. FHSA, First Home Savings Accounts, to buy your house that you will live in, and RSP is for your children. Investment platforms. What Simple, I talk about them a lot. Questrade, TD Easy Trade, Momo. So now, Wealth Simple, as I said, one of the things that you want to do is when finding an easy platform is when using a platform or finding a platform is an easy platform that you can do all your investing well and will automate your investing for you. And Wealth Simple does that for you. There's also low fees, literally low fees for you to invest. So that's like my number one account. Fractional shares, you can buy fractional shares, you can automate your investing. It just like does the thinking for you, basically. Now, other accounts, just in case we had other people from other places across the world, investment vehicles in the US, 401k plans, traditional IRA, Roth IRA, those are the plans for you to invest with. Vanguard, Robinhood, Fidelity, Charles Schwab, those are the places that you want to be investing and exploring investing in. If you were in the UK, the ISAs, so the individual savings accounts, like this are the accounts you want to be investing in because they have tax advantage. And the investment platforms are eToro, Trading 212. Those are platforms you want to explore. Another reminder, just as I'm speaking, you can check the pinned comments to ask questions. You're in Australia, tax advantage account, superannuation, managed investment funds. These are some of the platforms: Comsec, eToro, and CMC Invest. Yes. So now, how to pick your first ETF? I'm going to try and make this practical and show you guys like how I would look at VFV, for instance. But the first thing is management fees. I recently did a video where I was talking about the fact that you don't want to be doing mutual funds because mutual funds is super high. On average, an ETF's like fees is about 0.10%. Now, sometimes it can be lower or higher depending on the type of ETF. But then mutual funds, on the other hand, are like 2 point something. And now it may seem like, oh, what's 2%? It's not a lot of money, but it adds up. And over time, it will take a huge chunk of your portfolio. So I advise against mutual funds. So as I said, look at the management fees, the diversification and underlying holdings, the risk level, the volatility, liquidity, and long-term returns. So now let me try and do this, like how I'll look at if I was looking at VFV, for instance. I'm going to share my screen. Okay, yes, okay. So if I was looking at VFV, so VFV, someone asked me what S&P 500 is. VFV is an ETF that tracks the S&P 500. So basically, you would buy VFV and you are buying the S&P 500. That's what it means from the Canadian lens. So if I wanted to check how this portfolio or how this fund is doing or this ETF is doing, you can see that the MER is 0.09, which is pretty good. The market price right now is this. What else would I check about it? So total assets, that's also liquidity. So 27.62 billion. That's pretty good. There's also like distribution frequency. So dividends, because it's 500 companies, some of them pay dividends, some of them do not. But this is how much, like how frequently they distribute the dividends. So another thing I would see is kind of since inception, like how it has grown. If I put 10,000, this is how much it will have grown. Just not adding any money into it. Then risk and volatility. Okay, you don't need to do this one. What else would I show you guys? Yes, the countries. So now it's primarily invested in North America, the US of A, as I said. And these are the top 10 holdings. Another thing you want to see is the top 10 holdings. What companies are there? And as the biggest of the market right now is Nvidia, is top, Apple, and it's 8%. That's pretty high. Well, not high, but it's a good amount of exposure into that. Apple, Microsoft, Amazon, the big ones, the big fives. all of them are represented here. So this is what I'll be looking at when comparing the markets. Another easy tip I always say is, y'all use ChatGPT. Use ChatGPT. Literally just go in and say ChatGPT, compare VFV versus ZSP versus this. So first of all, you can even ask ChatGPT, what are the S&P or ETFs that track the S&P 500? It will give you, then say compare all of these ETFs, and it will give you the comparison based on all of these metrics. Or you can even like say, okay, using these metrics, and then that will help you choose. So guys, you don't need to always do the hard, oh, I'm researching. There's so many tools out there to help make your life easier. So now, when it comes to building your portfolio, there's different ways I recommend people build their portfolios. And I find that nowadays, like people just don't want to be bothered with having to think about multiple things. So a one fund ETF structure is a good place to start. Now, I don't really like the one fund just because like I feel like it limits me in terms of like how much exposure I want to have, for instance, to the US market versus the Canadian market. Right now, because of like how young I am and how aggressive or bullish I am of the market, I want to have more exposure to the US market. And right now, like some of this will not give me that. So sometimes I have to break my ETF structure for that. But if you are like, please just get me invested, these are great places to start. So XEQT, I've talked about this a lot, and I actually do invest in XEQT for my FHSA because it's like first one is medium term investment. And it's an all equity ETF, but based on different assets, like different geographic locations. So there's the US markets, there's emerging markets, there is developed markets, except emerging markets, and it's really properly diversified. Versus XGrow, now that one is 80% equity versus 80% equity and 20% bond. So if you're like, I don't have too much risk, I don't have a high risk to be buying XEQT that is all equity, you can go for XGrow. Versus Zilba, which is 60% equity and 40% bonds and fixed income. So you can see that there's literally a size that you will find an ETF for your situation, whatever works for you. You just have to do the research. So if you're thinking one fund, you just want to buy something and forget it, do this. And if you're asking, can I still build wealth with buying a one fund portfolio? Yes, you can. I know somebody, there's this babe that I follow in the US, and she literally just buys one ETF. And over time, yes, she also increased her income at later times. Like she increased her income after a while, but she literally hit a 1 million portfolio, I think a couple weeks ago at 833 or something. And the only thing she buys is one ETF every single month. And so it's very possible for you to still build wealth on that your one ETF. You don't have to think, oh, I'm not limiting myself. You're not limiting yourself by doing this. However, if you want more customization, you would rather do like a 4 to 5 fund ETF. Now, if you're thinking 4 to 5 fund ETF structure, the US market is always going to be top tier. That's where a lot of the innovation happens. That's where a lot of the companies and technologies you're using today exist from. So you want to always have the US market. The next thing is the home-based market. And I say this because like I live in Canada, you may not live in Canada, but whatever home base you're in the UK, Australia, whatever, have some exposure to that country too. It just helps your portfolio and it helps with the diversification layer. Then international markets, emerging markets. I always say this, emerging markets, I feel like in the future, I'm investing in them and I really see a lot of potential with emerging markets in the future. I feel like there's so many things under the hood that they're doing that is like, it's not really yet publicized to the world as much as other things in the US are. So emerging markets is such a good place, and developed markets except North America. Now, the final one is if you are interested, like it's not by force and it does not, you don't even need to do it. Like genuinely speaking, for most people, you don't need it. But if you're like, okay, I want to be invested in this whole AI thing, what's happening there? You can put some money into like industry specific ETFs. Now it can be AI, it can be you can just be interested, for instance, in makeup, like you really love fashion and beauty. You look for an ETF that tracks fashion and beauty. Whatever it is that you're interested in, pick that and then invest in them. So this is the 4 to 5 fund ETF structure that will work for you. Now, let's talk about some fears. Would you lose money? Or there's so much information out there. And I actually want you guys to comment, like, if yes, you have access to this video and equity and bond again. Okay. You guys will have access to the video, so you watch it again, then you speaking. Or I can answer the question later. But some fears, or will I use money? Oh, let me even see what I can quickly go. AI is THNQ. Industry AI TNHQ. I like that one. It has not super well. Super well since last time I bought it. So TEDAQ is one that is there. Um, then what was I also saying? Yes, some fears. Now, will you lose money? And there's so much information out there. The other day I was talking to someone, I was just like that. It's so interesting how every like there's so many great financial connect creators out there, but like every single time like one person video like does you just see all the followers follow. And I'm just like, I love it, but like I find that a lot of people are they just keep following people, but they're not taking action. And that's what I don't want you to leave out from here. I don't want you to leave here not taking action. Action can look different from different people, but I really want you to take the next steps, actually putting all of these things I'm saying into practice. Actually, like set up your accounts, like take some time off if you need some time to set up your accounts. Buy something, look like keep it safe. You can just buy like X60 or just something that tracks the S&P 500, but then start to actually do something out of all the information you're getting. Because I find that lots of people already have so much information to actually start doing something, but they are just not doing it. So there's so much information out there. See, definitely like follow people is very, very great to see what's possible, but definitely also streamline what you're seeing. Like you don't want to be watching things about the the next it's stock that will boom, because who told you it's going to boom? That's not the truth. If there's no workings behind the stock, how would they say it's booming? So like don't be watching things like, oh, the first five stocks that will make you a millionaire in five. Work something that is like okay, when you do your research it actually makes sense, it's showing workings. And also, will you lose money? The market, as I said, is risk investing in the markets always and always, and the market will always fluctuate. You will only lose money when you actually sell your stocks. That's another thing. Or your ETFs. You don't lose money if you're just watching your portfolio go up and down. At the end of the day, all of the money in my portfolio, I've not lost any money yet because I have not actually sold it. It's when I sell it at a loss that I actually lose money. And so should expect the fluctuations every single time. However, you bring it to life when you sell the stock. And so the goal is you avoid buying not quality ETFs or stocks. Like don't buy stocks or companies that you're actually not sure of, or all these like meme coins or whatnot. Buy things that are solid. As I said, the S&P, VFV, they've shown you the returns over here. So that's a good place to start. Now, simple strategies to grow your wealth over time. Um, all of the things I said or action things I've said is nice, but actually, how do you stay in the market? Because I find that also some people start to invest and after they're just like, oh God, I'm leaving. No, you have to start early and be consistent. That's important. Be consistent. Consistency over just buy and run away. Consistency trumps it every single time. Build a routine. And that's why I also mentioned automation. It also makes your life very, very easy by automating stuff. Live below your means as much as possible. Save and invest automatically, as I just said. Diversify your investments. Choose a properly diversified portfolio. I've shared you guys a 4 to 5 fund ETF that is pretty solid. A one fund ETF if that's what you want to do. um Reinvest your returns. Now, for instance, on World Simple, you can reinvest your dividends automatically. So that's what I do. I don't ever get the money cash. I just reinvest it and continue to add. And focus on long-term investments. As I said, focus on long-term. Get into that mindset of like, it's not it's not a get rich scam. Like if you're interested in passive income, for instance, I know somebody mentioned that yes, you can make money from passive, you can make money like the passive income from investing, but now you want to probably focus on dividend investing, and then your portfolio has to go to a huge amount for you to be like, okay, yes, I'm earning a lot in dividends. I think I did the math the other time, and I think I've gotten like 2K in dividends like this year, but my portfolio is not heavily on dividends. But irrespective, it's even just in reinvested in the market. So if I wanted to actually take that money as passive income, that's a great way for me to get money out of the market. So you could also do that depending on your goal. Now, taking action, or before I go on, let me probably actually go to the questions. Let me try to start to answer the questions. Let me start to answer the questions if there are any. Okay. Now, let me start to answer the questions before I talk about actually, let me first of all finish take action. Now, as I said before, action is the goal. Like that's where we want to get you to actually taking action. And action looks like different things for different people. It can be like you actually saying, okay, Rimike has shown us this way. Go to this platform, whatnot. I'm going to do exactly what she has said and do that. And then for other people, they actually still know that guided help. And there's nothing wrong with that. But you need to identify what type of action you need. So that's very, very important to do to know. And if you need guided hand, like reach out to people like me. I have one-on-ones and I'm actually even launching an investment thingy for next year. I'll share more about it soon. But then take action. That's what I want to leave you with. So now let me start to answer the question. So the first one is I'm a student who currently works part time. I want to know your thoughts on having a one funded portfolio. I feel like I kind of already answered this, but as I said, a one fund portfolio is not a bad place to start. If you are super busy and you're currently working part time, I think it's fine for you to do that. If that's what is going to get you to invest, it's fine for you to just buy one fund and just keep it moving. Now, as you get to start to get more information, get more knowledge, you can now decide that you want to split it up. And also, you may decide that you don't want to split it off. Like that's another thing. Stick with your investment thesis or whatever it is that works for you. Because people are saying buy a four fund, buy a whatnot, you don't have to do it. I know there's this finance connect creators that I follow, Steph, and then he they are a couple. Dan buys one ETF, Steph buys multiple. Everybody is focused on their own investment. So stick with your plan. If that's what is going to work for you, then start with that. Obviously, as you get more information, you cannot decide, okay, I want to have more exposure, for instance, to to the US market, especially because I'm a student, I'm young, maybe I need to be more aggressive. That's fine for you. But if doing that one fund ETF, then go for it. Start with that, and then you can build as time goes on. Somebody asked, so many misconceptions about home ownership. Is it better to live in your house or rent it out and invest the money instead? Some say long-term investing can outperform the home's value. I definitely hear you. And I'm saying this as somebody that I was, I was very, very like I've had a lot of crash outs with me buying my house. However, as I something I always do every single time is that I always run the numbers. So even before I came to Canada for my student loan, I ran the numbers of different scenarios of what will happen based on whatever income whatever income it is to be able to pay off that student loan. So with me buying the house, I ran the numbers of every single scenario. If I kept my money invested in the market in the next 10 years, how much will I have by then? If I just buy the house plus my additional investments and everything, I even use like worst case scenario in markets and whatnot. And it was still a better choice for me to buy the property at that time. And also because it's an investment property and I want to be diversified in my portfolio. So for me, buying that property was also a form of diversifying my entire portfolio. So that worked out for me. Um, then is it so for me? I'm still going to be renting. Like my day-to-day living, I am renting. However, I have the house that is giving me rental income, and I'm building equity in it. Um, some say long-term investing can outperform. I definitely do agree. As I said, some long-term investing can outperform the home's value, but then it's doing the math for yourself. Run the numbers for yourself. Run the numbers of possibly house that you want to get. I know some people that they rather buy like old houses and get the cash flow. They're not really worried about the equity piece of like selling or whatnot, but they can take equity if they refinance though. But like they just want the cash flow to be able to invest more. So you see, like there's different streams for different people depending on your goals. But run the numbers for yourself. If you run the numbers and it does not make sense, then do not do it. But I'm very pro renting. I still rent. So Carrie elaborates more on why you think mutual funds isn't so great. Fees. That's really it. Like it's the fees. I don't know whether I have the math again, but like I did a math of like of imagine if I invested 100K in mutual funds versus even doing 100K in the managed funds of Work Simple. And over time, I'll have in 10 years, that's when I'm not adding extra money. I'll pay 30,000 in what they call it in fees. Imagine it's not 100K and it's 1 million. That's like 300K in fees when you can get cheaper. Like, no, don't do that. So, mutual funds, I do not recommend, especially in Canada. Like, there's so many better options, or other parts of the world. There's so many better options than mutual funds. ETFs is a better option for sure. If even you don't want to do ETF and you want to do managed funds, do what simple and question managed funds. It's still better than mutual funds. Yeah, there's too much cost with that. So what are taxes charged on ETF investment returns? Okay, so now this is depending on account types. If you are doing TFSA versus FHSA versus RSP, that's what's happening. So okay, there's two different withholding tax. Okay, so there's withholding tax on US ETFs 0.15, but that is taken automatically out of the gate. Like you don't even get to experience like them taking the money from you, really. So I don't think you should worry about this. I've talked about this before. Like I feel like it's not a big amount for you to be worried about, because it's also taken out of the bat. And also depending on which account you have it in. If it was in your RSP, for instance, you probably will not get that tax taken out. Yes, so I'll say those are the taxes. Withholding taxes just at 0.15% on returns and dividends. Then what else will I say on taxes with ETFs? The other things would literally just be based on their account. So TFSA versus FHSA versus RSP. TFSA, you don't pay no taxes, apart from maybe the US one, withholding tax. FHSA, you also don't pay taxes, also because the goal is that you take that money to buy a house. Now, if you do not take that money to buy a house, you have to convert it to an RSP, put in your RSP. And now RSP is the one where you actually get taxed later on in the future. And I know there's a lot of conversation about, is it better to even not invest in the RSP because you're going to still pay taxes later on, and what if my tax rate is still high, which for most people actually is still high in their old age. So in that case, you probably have to work with like a retirement planner or somebody to actually know how you structure which accounts to take money out. It's very, very, no, I won't say it's very, very complex actually, but it's just like there has to be some math to how that will work. Yes. So somebody said you took a second job to increase cash flow, but people say having two jobs makes employer thinks you're less dedicated. How did you manage that perception and show it won't affect my performance? So I'm going to say that I was very, very stressed. I was very, very, very stressed when when I was doing two jobs. I don't recommend for sure. It took a lot from me. I'm not even going to lie. It took a whole lot from me for me to be able to manage both of them. But I also recommend that don't do two full times though. Like do one full time and maybe do a part-time job. Like don't be trying to do two full time. That's a lot, really. So if you can look for a structure where you're doing two full time, one full time and one part time, that's perfect. I know some people that do two full times too. If you're able to manage it properly, do what works for you. Do you understand that you don't get laid off? Um, that's it. So for me, it was tough. Like literally, it was tough, and that's why I said never again. I'm going to stick to my 9 to 5 only and just do that for sure. So, what is the best banks to use for my emergency fund? So, what is the best bank? Is There's different banks. I recommend Neo Financial, EQ Bank. All of those banks are great banks for you to use. Thanks so much for this webinar. I really want to start investing in 2026. Is it possible to get the recording? Yes, you can go back to the recording, and then there's a lot of questions. Let me pause a little bit and come back to this. So I also wanted to share something that, yes, running numbers is great advice. How did you do math to determine? Okay, I would explain that soon. But I wanted to share something when it comes to action. Something I'm also doing next year is starting like a cohort-based investing. I don't know if this is that. Yes. So this is Investing Confidence Accelerator. Now, this is for people that really want the hand holding, where they're like, okay, I actually need somebody to hand hold me. And this is going to be core based. I'm really, really limiting the number of people that I work with. Like, it's not going to be even up to 20 people. Like, so this is something for you if you're interested. And if today you actually like lock in, the price is way cheaper than next year. Yeah, depending on how many people register. So it will be a 6 weeks experience to get you invested and confident. So module one, we're going to be defining your financial freedom. And that's very important because I find that people don't actually know what their goals are, what they want to build, what the numbers is. And so it's actually determining what you want for yourself, not what the world is telling you to do, but what you want for yourself. Module two is setting up your account and tools. Now we're going to sit down together, set up your accounts, your TFSA investment account, wherever it is, move you over to the right account and give you tools to actually invest. Then module three is foundations of investing. So We're going to look at all the foundations, go deeper into some of the things I talked about today, the mindset piece, staying in the market, all those type of things, foundations, all the stocks, equity, what they mean, bonds, the difference between them, how that matters. The next level investing strategy is also like dollar cost averaging, strategies that will actually help you stay investing, and all the things you need to know about the markets if you want to evaluate a stock, for instance, because I know people are still interested in stocks. I still like to do stocks, and I think I'll still do stocks like next year. How do you evaluate a stock? How do you look for new stock options or just things to companies to look at? Building your portfolio together, this will be very, very hands-on. That's the goal for you to actually will build the portfolio and think long-term according to your goals. And module 6 is staying on track and planning for the future. So now this is going to involve like, how do you rebalance your portfolio regularly? How do you ensure that you have set a goal to hit like a certain amount at some point? How do you actually hit it? How much do you need to invest? How much do you need to make? All those type of things, and planning for the future. So this will be quarterly. Core one will start in January 2026. 6 weeks live, is not recorded, whatnot. It'll be live, actual conversations type thing. And this is what you get. If you do the classic, you have 4 private 1-hour sessions with me, lifetime access to all of the resources. You get your personalized portfolio feedback and strategy, investing templates, trackers, calculators, all the things I do. Someone was asking me about how I evaluated, like, for instance, buying a house. Those type of things will be there. Weekly office hours with me, and you have a private community. And also, this is not going to be like a lot of people. The goal is to really keep it intimate and small. So that'll be 350 if you decide to do that today. But the entire thing actually program starts next year, January. And then if you do the 550 elite, everything in the classic plus, you get full access to all my digital products. I have budget trackers, savings trackers, all of those things. And you have 1 year access to me. And so that means you have access, like, message me about like your portfolio, what's working, what's not working. We'll have quarterly check-ins as to how you're hitting your goals, what you need to add, how do you need to rebalance. And that will be 515 for early access. So let me know if you guys want to do that. Let me put if you're interested, put the link in the bio while I continue to ask questions or answer questions for people that are still here. Okay. So this is it if you are interested. Yeah, okay. So what do I think about Questrade? Okay, yes, recently moved my mutual funds. Yeah, I agree. What do I think about Questrade? I love Questrade. However, I also recently moved my portfolio from Questrade. Yeah, if you are interested in a payment plan, please reach out to me directly. I would like let you know for that, for payment plans for sure. Let me continue to answer the questions because there are a lot of questions. Let me continue. Okay. So yes, Questrade. I really love Questrade. However, I've had to recently move my Questrade portfolio back to Wealthsimple because now Wealthsimple has everything I offered or I need. They have made it just way easier for me to invest. And also like reduce costs, because there's also this thing called Nobby Gambit, where you're trying to reduce the cost of buying US stocks or investments. And now Questrade was like one of the only ones that had it that I liked using. But now Wealthsimple is also reducing that. So I'm just like, the trade-off for me was just like, I'd rather have everything in one place. I feel like also as I start to get older, not like I'm that old, but I'm just like, I want everything in one place versus going back and forth with different accounts. But I do love Questrade. That was the first account I started with. I feel like with Questrade, they didn't bet on themselves a lot. Sorry that I'm talking about this, but I feel like they didn't bet on themselves a lot to be able to release some of the products that Wealthsimple started to release early on, but still a good place to start with. So now, can you explain emergency fund again? And should we prioritize emergency fund before investing? That's a great question. So as I said, emergency fund is 6 to 12 months. Now, if you Google it, they'll probably say 3 to 6 months. But I feel like with the uncertainty in this world, I like the 6 months to 12 months, 12 months amount, because I just feel safer and at peace with that amount. So as I said, it's 6 months of your living expenses. So how I'll calculate this, for instance, is that looking at me, like my fixed income that every single month I have to pay, my rent, my groceries, my utilities, those things I always have to pay for them every single month. So if the amount, for instance, is 2005, I'll do 2005 times 6. How much is that? My brain is not working first right now. But 2005 times 6 to get me at 15,000 for my emergency fund. So that means my emergency fund amount to be 15,000. Now, the other question now is, should you prioritize emergency fund before investing? I think you can do both. You can do both every single time. I just always want to say that you should still save for emergency fund. That's the goal. Like, I don't want you to just go 100% investing without your emergency fund. So the way you can split your money is that you can do, okay, for instance, even if it's $100 every single month or however works for you, you're putting $100 towards your emergency fund as you're investing in the stock market. And a better thing is to even like just save like a starter emergency fund. So you can say, okay, I'm going to save 3K, for instance, and just like hold that 3K and then now start to add more money small, like regularly to that emergency fund while you are investing. So you can do both simultaneously, but just ensure that you are also building your emergency fund. So, as someone who doesn't even have the basic of investing or how to identify good ETFs, do you have a training or books one can study in order to know what to buy and best time to buy as well? You can join the cohort starting in January for that. Use the link in the chat. Now, can a temporary resident with a work permit? Yes, you can open a TFSA. As a student, did I open a TFSA? Yeah, I think so. Yeah. As a temporary resident with a work permit, you're still a resident of Canada. You can open a TFSA for sure. Can I invest as low as $50 a month in my TFSA and RSP respectively while building my emergency fund? Yes, you can. I said like even this year alone, I've just been doing $100 every single bi-weekly. I have people that are doing like $25. And even though it may seem like $25 is small, it adds up. It really does add up, especially when the market's moving good. So invest as low as possible, $50 a month in your TFSA and do that as long as you're investing. $25, $20, do that. What do you mean by ETF fees? So ETF fees, MER. Let me see if I can share my, or I'll just try and explain it on here. But MER basically is management fees, and that's the fee for them managing the portfolio. That's really what ETF fees are. And if you Google like whatever ETF it is, XEQT, VFV, just say what is VSV's MER or management fees, and it will pop out for you. So that fee is literally the cost for managing the ETF. That's really what ETF fees are, and all of them would have fees. 0. I keep the bar between like as long as it's less than or equal to 0.10%, that's a good ETF. Now there's some like XEQT, because it's a total market ETF, it's on the higher side of 0.20. And I don't mind it because you know that it's a one fund ETF that you're buying. Okay, so please, any clarification on why you said to stay away from mutual funds? What are the alternatives to this? The alternatives to this is ETFs. Mutual funds, no. ETFs, yes. That is the alternative. And another alternative is managed funds. So if you rather like just okay, I want them to do the whole work for me. Maybe the actual alternative is managed fees, managed funds. You can do Wealthsimple's or Questrade's managed fees. Questrade managed fees is a total of 0.50%, and Questrade's one is 0.320%. So Questrade is actually a little bit cheaper, so you can actually go with Questrade for that for that reason. But then all you actually need to do is, because all you need to do here is to just go to your new platform, like maybe it's Questrade that you want to go with, and tell them that you want to transfer your funds from your mutual funds to their managed funds. Well, Wealthsimple has made it easier. You can actually even do it directly. Just go to their platform and say, okay, I have mutual funds with Manulife and I don't want to do this anymore. I have mutual funds with TD. I don't want to do this anymore. How can I transfer it to your managed funds? And they would do the work for you to transfer it to their managed funds. So that's a better alternative. Managed funds on Wealthsimple. If you have any questions about it, you can reach out to me on how to like do that. But it's literally on their platforms. You go to portfolio and you find the managed funds. I'm a new investor. I have the following ETFs in my TFSA: VFV, Vigro, ZDQT, and I own share of CU, Canadian Utilities, and Enbridge. My goal is to buy a house and build wealth. I think this is actually not a bad portfolio. I feel like there's overlaps to those because VFVs, Vigro, ZDQT, there's a little bit of overlaps there. Is it that you can decide to do just ZDQT and just like keep it that way, or maybe just do VFV and VGrow to give you that exposure to like bonds and whatnot. But this is not a bad portfolio. I definitely want to reduce the ZEQT though, because I feel like there's no need for that with the VFV and VGrow. And the one share of CU and Enbridge is not bad. What I also recommend is that you just continue to invest regularly, automate your investments, continue to invest in this ETFs. You can reduce ZQT. Enbridge is also good, and Canadian Utilities is great for dividends. So I like them too. I think I do actually have them in my RSP account. So do that regularly and continue to increase your positions on them continuously. So what does 100K portfolio mean? That means I have 100K in my, when I open the account, it's 100K. I did not put 100K. I literally probably put like 40K, genuinely speaking, because my portfolio is up like 60%. So I probably put like 40 to 50K cash. And actually more than that. But the market has done the work for me to get 60K in extra. So now the total is 100K. That's the simple math I will explain there. I opened an FHSA account just because I want to buy a house. Do I have to buy ETFs with my FHSA? Yes. Do not save. Okay. So first of all, what is your timeline? Like, when are you thinking you want to buy the house? Are you thinking you want to buy the house next year? If it's next year, then maybe just do a GIC like in your FHSA. But if it's like you have a long term line, like 3 years, 5 years timeline, or like medium term, I would suggest you do XEQT or something that is like balanced. You can even do ZBAL, something that is balanced, low risk. I did XEQT because I'm still all equity, high risk. But you can probably do like ZBAL balanced or XBAL. That's a good ETF to buy, but definitely buy an ETF in your FHSA, especially if your timeline is a long time. Is there any specific amount you recommend to invest every month in RSP to manage mid-risk tolerant portfolio? I would suggest anything that you can consistently invest every single month. Like I can't always pull out numbers and say, oh, do $500. I can't. But if that's not your reality, it does not make sense for you. So the specific amount will be what you can consistently put in every single month. If it's $100, $200, $300, just put that regularly and continue to try to increase your income, to increase your investments. Really, that's what I would say. Yeah, that's just specific amounts. Yeah, that's what I'll say. Put what you can put in. Regarding my one fund portfolio, I invested in the Canadian ETF VQT. Should I change to a US ETF? I've heard people say the Canadian economy is great, and as a student, I don't know much about the economy. Okay, yes. So something that people always confuse is that because it's sold in Canada, does not in Canadian dollars, does not mean that it tracks the Canadian market. And that's why I say you always need to go in to evaluate the ETF. So if you actually check VQT, VQT is a ETF that is invested 45% in the US market and then 25% in the Canadian market. Let me actually show that so you see. Like, because you buy it in Canada does not mean that a does not mean that where is VQT? Just a minute. Okay. Does not mean that it is just invested in the Canadian market. No, they made it easier for us Canadians to buy it. That's why it's in Canadian dollars. But then you are still trying to invest in the US market. So let me share that. Let me share. So you see that instead. Okay. So now this is VQT. So as I said, like one fund ETFs, they kind of have a higher MER. So that's the fee, 0.24%. It's not bad if this is an all equity like that you're buying, as I said, all equity portfolio. Yeah, one time. But see this VQT, this is the market allocation. It is 45% in the US of A, 30% in Canada, and 4% in Pacific. Then there's like other like emerging markets, Europe, and all of those things. So yes, you are buying VQT, but that does not mean that you are just investing in the Canadian market. You still have a huge what do you call it? But you're still invested in the US market. So that's something to note there. Then let me see. So you don't need to change it to a ETF that is in US dollars. No, it's fine for you to keep it as VEKZ because you still have strong exposure to the US market, like 45%. Now you can decide that, oh, you want more exposure to the US market, then you can now add in maybe VFV, for instance, to just track the S&P 500. But I think that's not a bad one to do for sure. What is the allowance that is a tax-free and we can contribute to the TFSA account? Is there a threshold? In the UK, we have 20K allowance tax-free for ISAs. For ISAs, what's the Canadian equivalent? So the Canadian equivalent is 7,000. Depending, they give the numbers yearly. This year was 7,000. Next year is also 7,000 to your TFSA account. However, something you need to know is that your contribution room builds up. So, for instance, me, I moved into the country. Just a minute. Let me show you guys how to calculate your TFSA, and I can put this in the link too if you want to learn how to calculate your TFSA. Yeah, so if you want to calculate your TFSA, I just put the calculation there. But let me show you how it is. So if I want to calculate my TFSA, yes, there's every single year you have a limit. They'll give you this year was 7,000, next year is also 7,000. But then depending on how long you stay in Canada, your contribution room increases. So for me, for instance, I was not a resident. What year did I become a resident? It was 2019. I'm a young girl. How much have I? Let's say I've not contributed anything to the TFSA. My contribution room as at this year is 44K 500 that I can contribute to my TFSA. So your contribution room increases. Now, for instance, if I moved in 2019 and I've never for one day contributed to the TFSA, and I would decide that this is the year I want to start contributing to the TFSA and I have money, I can contribute up to 44,500 this year. Now, next year, obviously, if I max it out, I only have the 7,000 contribution room. Now, for the FHSA, on the other hand, the contribution room is 8,000 every single year up to the maximum of 40,000. That's FHSA. And with that one, also is on the contribution room starts counting the day you open the account. Not like how with the TFSA, you don't even need to open the account for your contribution to start accruing. Yeah. Let's continue. Yes. So hi, checking in. Hi, just checking. I sent an email earlier, but may I missed your. I get a lot of emails, genuinely speaking, and I try to answer, but not everybody can be. It's not everybody I can respond to. You can book a one-on-one call or just like send me a DM or something and see like I could answer you. And even DMs, I try to respond to my DMs a lot. So in 40s with debt, student loans, and credit cards, do you recommend prioritizing debt payoff or investing while paying off, considering you said the money needs time in the market? So I definitely say credit cards is high. Credit cards has a high interest. So I'll definitely, even if your student loan is not as high, like your interest rate on your student loan is like, so when I say high, like if your student loan interest rate is like less than like 7%, like or less than 6%, I can say you can continue to manage it with investing. However, with credit cards are high. So I'll say you prioritize paying off that credit card one first of all. And then you can now start to really prioritize the money in the market. Because the reality is that the money or the time in the markets benefits you're trying to take advantage of. If you're paying high interest, 21% from credit cards, is going to eat up and it does not make sense. The math will not make sense again. So definitely prioritize that your credit card if it's just your credit card that has high interest. If your student loan is also high interest, I'll just say prioritize paying those off first. You can still be doing like something like maybe $100, whatever capacity you have to invest in the markets too, but I'll say prioritize paying that debt off, especially if it's high interest. If not, like the savings does not make sense. Can you please walk us through how to invest using the World Simple app? I have done a video of it recently, I feel. I don't know, but I will probably do another video. I can't, it's hard to share my screen right now with my phone, but I will do another video on it on social media so you can follow me. So if you're a temporary resident with a work permit, yes, you can open a TFSA account, and investment company do I recommend Vote Simple. I have $100 to invest, but still credit card debt and no emergency fund. As a student on minimum wage, should I focus on savings and debt first or start investing now? My parents are my sponsors. Credit card debt is super high interest. I would recommend you pay that off first. Like I don't know how much it will be, but pay that credit card, like put that extra money towards that credit card debt first. And you're still a student, so you're still young. So don't be too stressed about it. Irrespective, you may also not be young. Sorry for saying that. But irrespective, my point is um don't don't try and be trying to invest $100 when you still have credit card, especially if your parents are still your sponsors. Yeah, it seems like you're young. So pay off the credit card first, then put the $100 towards your investments. That's the best bet I would say for that. Um, I forgot that you have no emergency fund, and or do both of them simultaneously. Pay off your credit card first, then the remaining money that you now have after you paid off your credit card, split into your emergency fund and your investments. And that's also because like you have your parents are still your sponsors. Is it possible to invest solely for short-term goals like buying a car? Also, you got the house you got. Is that an example of real estate investment and how? Yes, the house I got is an investment property. I'm not living in it. Yes, and I even tried to be very creative with how I rented the apartment, the the house. It's a three-bedroom, two-bedroom, three-bedroom, and finished basement. So I rented it room by room. But yeah, so that's how I did it. Is it possible to invest solely for short-term goals by example buying a car? I'll say it's really risky to invest for short-term goals. Like how short is your timeline? It's really, really risky because the market can go wrong. And I don't like the concept of timing the market. I know some people like it where they will be like, oh, the market is going down now, locking, locking, locking. If you're in a situation where it's like, oh, the market went down, then put in money, buy, 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 buy. But like, don't be like holding your money and be waiting for the time for the market to go down before you invest. Like, just start to do dollar cost averaging and continue to invest. But then when it comes to this question, I don't recommend it, genuinely speaking. So okay, so that 100K profit, does that mean you can actually take out that 100K to buy a house, for example? Is the 100K actual money or just money you yeah, it is money. It's real money. It's not fake money. Um, just money you acquired over time. Yeah, it's money, like it's real money for my portfolio. I don't understand that question. Yes, and I took money from the 100K to buy a house. I'm thinking of buying a house in 5 years. So should I just buy one ETF in my FHSA right now? Yes, you can do XQT in your that's all equity. That's a good one to buy there. When you say automate investment, does that mean investing the same account in a specific period of time? Example, $50 every week? Yes, that's what I mean by automating your investment. When I start investing in one fund ETF, for example, do I need to be tracking the market and studying it and looking to build wealth long term? Not investing for any specific. Yes, I love that. So I would say yes, you can start with investing in the one fund, but then continue to educate yourself. Like there's so many great books to read. There's how to the path to build wealth or the simple path to wealth. Also like learn the market, like just track the market, or even just sign up to newsletters. Like there's so many great newsletters out there. There's the peak. I really like that. I also have a newsletter, but I've been inconsistent. But next year. But there's the peak. I really like it because they talk about the markets, what's happening in the markets, what's driving the market growth. But Simple also has um a whatnot a newsletter. Another platform that I recently signed up to was Motley Fool. And Motley Fool because I wanted to really understand more, like get ideas for individual stocks that I could evaluate. I haven't even gone on the platform to really see what they're recommending. But like Motley Fool is also a good thing, but you have to pay for that one still. So track the market. Just be in sync with what the market is saying. Like that's why I said newsletters are a great place to start because yeah, like you have an idea of what's happening. For instance, you know when earnings report is coming, you know what to look out for and things like that. And then as time goes on, you now start to think and it even helps build like what your investing thesis is, like what do you want to buy into, what do you want to not buy into, that type of thing. So since there's an overlap in portfolio, should I sell the Vigor and Zeki? I think if is the question of Vigor, and I would say sell the ZEQT specifically and keep VFV and Vigor. Yeah, I feel like if it's in response to this question, yeah, keep the VFV and Vigo, but just still know that you still have higher exposure to the US markets, depending on like how much you're investing. But yeah, you can set the ZQT genuinely speaking. Um, yes. That's it. Any other questions? Let me go back to the what thank you guys. So what's the paper you're checking the ETF value on? So I checked the ETF value on like I just literally just Google like VFV. That's all I did. I'll show you guys what I did. I literally just say, oh, VFV and it will come out. Yeah, that's what I just need to do. And then I can look at it and like determine, like they won't say like ETF facts, fact sheets that will show you literally this is probably even what you need to download. The ETF fact sheet is the best thing to probably do because you can see at a glance every single thing, the sectors, um, the top 10 investments, MER, all those type of things. So definitely even just download this and then look at it. And that's probably the best thing for you to do there. So just Google it and it will come out. And yeah, I feel like that's everything. Let me know if you guys have any questions. Thank you guys for joining me for 1 hour, 30 minutes. I don't know if there's any other thing that I'm left to say, but that's really everything. Thank you guys. I would send the recording to people that signed up for this class. And thank you guys for staying. I really do appreciate you. I don't know if you guys have any more questions, but it's time for me to go. Thank you. Thank you guys so much. And if you're interested in learning more about the investment accelerator thingy, you can reach out to me. If you guys want a payment plan, I can work that out. But we are starting next year, January. That's the goal for that one still. So why am I doing this to myself? Share this tab instead. Yeah. I will not be sharing the slides though. I'll just be sharing the recordings because I'll still use the slides. But yes, if you're interested, as I said, just reach out to me. This is what it's about. Classic 350, early access 550. Let me know. Let's get you investing. Let's get you on the journey. But the goal is for you to take action today. Thank you guys so much. Bye bye. Thank you.